Get ready for the biggest EV shakeup. Rivian shares have plummeted 30% this year, trading near $13.35, but the future looks bright with the R2 launch approaching. We dive into the details of this massive product push, the Uber investment, and what it all means for the company's trajectory. Electric heavy-duty truck competitive against diesel, and what this means for fleet operators nationwide. And finally, we wrap up with the critical question: can Rivian actually outpace Tesla in 2026? We weigh the bullish price targets against the execution risks, and we tell you exactly what you need to watch for to see if this stock hits its breakout potential. Stay locked in for the rest of the show. Analysts are suggesting that Rivian's stock, currently trading around $13.35 after a 30% decline this year, could potentially outperform Tesla in 2026, contingent upon the successful execution of its upcoming product strategy. Despite its lower valuation and ongoing profitability challenges, Wall Street attention is increasingly focused on Rivian following the commencement of production for its R2 electric vehicle. The company has begun producing saleable R2 models, with employee deliveries complete and customer deliveries anticipated this spring, while reaffirming its 2026 delivery guidance of 62,000 to 67,000 units. The R2 is positioned as the critical vehicle expected to transition Rivian beyond its initial models, aiming to capture a broader market segment. Pricing for the initial 2026 R2 versions is set at premiums starting at $55,485, and performance launch at $59,485, with the more affordable standard model slated for 2027. Further bolstering the R2 narrative is a significant commitment from Uber, which agreed to invest up to $1.25 billion through 2031 and is expected to purchase 10,000 autonomous R2 robotaxis, with potential for up to 40,000 more starting in 2030. This partnership provides a substantial commercial validation beyond traditional retail sales. While Tesla remains the dominant force in the EV market, the argument for Rivian centers on its lower valuation and the belief that successful scaling of the R2 could redefine market perception. Analysts highlight that Tesla's valuation incorporates multiple future revenue streams, whereas Rivian is viewed as a higher-risk, higher-upside play dependent on overcoming current profitability hurdles. Analyst targets reflect this divergence in sentiment, ranging from a bullish $25 target from Benchmark's Mickey Legg to a more restrained $15 target from D.A. Davidson's Michael Schliske, underscoring that the stock's future performance hinges entirely on execution. The core thesis is that if Rivian successfully launches the R2 on schedule, expands its customer base, and demonstrates progress in cost management, the market may reevaluate the company's standing, potentially leading to significant upside in 2026. Analysts are signaling potential upside for Rivian, suggesting the $13 electric vehicle stock could outperform Tesla in 2026. While Tesla maintains its position as the dominant player in the electric vehicle market, Rivian is increasingly capturing Wall Street attention due to its unique profile as a smaller, riskier, and still unprofitable EV maker. Rivian shares have experienced a significant decline this year, trading near $13.35, reflecting a valuation significantly lower than Tesla despite growing optimism surrounding the upcoming launch of its R2 vehicle. the central focus for Rivian's future hinges entirely on the R2, a midsize electric SUV designed to expand the company beyond its existing R1T pickup and R1S SUV offerings into a more competitive market. The company has commenced production of saleable R2 vehicles and has begun employee deliveries, with customer deliveries anticipated soon, marking a shift in focus from proving EV viability to demonstrating scalable production capabilities. Pricing remains a key consideration. The initial 2026 R2 versions are priced at $55,485 for the premium and $59,485 for the Performance Launch Edition. A lower-cost standard model is slated for a 2027 release. Despite this, Rivian has reaffirmed its 2026 delivery guidance of 62,000 to 67,000 vehicles, driven by the anticipated impact of the R2. Further bolstering the commercial narrative is a significant partnership with Uber, which has committed up to $1.25 billion through 2031 and plans to acquire 10,000 autonomous R2 robotaxis, with options for expansion. This deal provides a crucial commercial customer base beyond traditional retail sales, although it does not immediately resolve the company's current financial losses. The divergence in market perception stems from valuation and risk. Tesla commands a premium valuation reflecting its established brand, diversified future revenue streams in software, robotics, and batteries, and proven business model. Rivian, conversely, is grappling with a beaten-down stock price and ongoing losses, leading to investor skepticism regarding profitable scaling. However, analysts believe this lower valuation presents a higher potential upside. The market's outlook is contingent on the successful execution of the R2 launch, delivering the vehicle on schedule, expanding the customer base, and showing progress in cost reduction. While Wall Street remains cautious, with price targets ranging from $15 to $25, the core thesis is that if Rivian executes successfully, its lower valuation could position it as the higher upside stock in 2026, even as Tesla navigates its own regulatory challenges. Speculation is mounting that Tesla and SpaceX are on a collision course, with credible voices suggesting a merger could create a sovereign AI company. Deepwater Asset Management's Gene Munster estimates the odds of a combination within 5 to 10 years to be over 50%, envisioning an entity encompassing physical AI, robotaxis, Optimus, and SpaceX's launch capabilities. This convergence thesis is further reinforced by Walter Isaacson, who has noted the ongoing pattern of Musk consolidating his AI ventures. Financial linkages between the two companies are visibly tightening. Tesla invested $2 billion in SpaceX and is collaborating with the company on developing the largest chip fabrication facility in the U.S. at its Gigafactory Texas campus, alongside a deal with Samsung for advanced AI inference silicon. Tesla also reported significant revenue from both entities in 2025, booking $430.1 million from xAI and $143.3 million from SpaceX. Analyst sentiment reflects this bullish outlook. Wedbush's Dan Ives has assigned merger odds between 80% and 90%, while Ross Gerber has dubbed the potential entity a Berkshire Hathaway of AI. Musk has consistently framed his ventures around shared needs, including chip design, robotics talent, and manufacturing. The potential upside for Tesla shareholders is substantial, offering exposure to SpaceX, Starlink, and xAI under a single ticker, with a potential SpaceX IPO valuation near $1.75 trillion acting as a major anchor. However, the risks are significant. Concerns center on potential dilution, governance complexities, and the extensive regulatory scrutiny that would accompany merging a public automaker, currently trading near $410 a share, with a defense-adjacent rocket company. Currently, market skepticism remains high, with polymarket traders pricing the probability of an announcement by the end of 2026 at only 17%. Investors are advised to closely monitor Tesla's Q1 2026 8 filing for further developments in this convergence story. California is proving to be a critical, albeit contentious, market for Tesla's latest offering, the semi-heavy-duty truck, as the state's robust clean truck incentives are driving significant adoption. The vehicle has attracted over 1,200 California HVIP vouchers, valued at $172 million, representing double the awards given to competitors. These vouchers offer substantial discounts, reducing the sticker price of the semi by $120,000, which ranges from $250,000 to $290,000 depending on the range. This surge in interest is fueled by soaring diesel fuel prices, which have jumped nearly 50% since the start of the U.S. war with Iran. Despite CEO Elon Musk's public criticism of California's regulations and his assertion that Tesla does not rely on subsidies, the state's programs are effectively making the electric semi more affordable than its diesel counterparts. Tesla has previously earned over $13.5 billion in indirect government subsidies through pollution credit sales. California's support extends beyond HVIP vouchers. Fleet operators can access the new $1 billion Clean Fuel Reward Program and incentives from local utilities and environmental agencies, potentially covering up to 90% of a semi-truck's purchase price for small fleets. These state funds are generated through cap-and-trade programs and low-carbon fuel standards, aimed at reducing air pollution from heavy-duty vehicles near ports and freight hubs. Experts note that California's combination of HVIP funding and stacking benefits positions it as the most compelling market currently. While California is the primary early market, Tesla also anticipates strong demand in Texas and the Southeast due to favorable electricity and diesel prices in those regions. However, infrastructure remains a key hurdle. Analysts point to a mismatch between the number of operational electric trucks and the public fast-charging network, noting that several counties with significant voucher commitments currently lack rapid charging stations. Tesla is addressing this by developing 50 public charging stations, partnering with truck stop operator Pilot to install chargers across several states, and expects more than half to be operational by year-end. The economic viability of the semi hinges on sustained high diesel prices. Experts caution that if diesel prices revert to pre-war levels, the truck's long-term competitiveness will be jeopardized. For the electric truck to succeed long-term, it must outperform pre-war diesel levels. The current pricing, bolstered by California's incentives, makes the 300-mile semi attractive now, but the future depends on sustained market conditions and infrastructure development.